Hello, everyone. Welcome to another exciting episode of the Financial Insight Show. My name is Chibesakunda, and I'm your host, and I'm currently at Africa Works Agora in Lusaka, Zambia, where I'm about to have a conversation with the CEO of Finwise. So stay tuned for insights on this particular episode.
Welcome back. It's Chibesakunda again, and yes, like I indicated in the intro, that I'll be speaking to the CEO of Finwise Analytica, which is an analytics company that is based in Zambia. The CEO is Chiti Kalinda. Chiti, how are you doing?
Very well, thanks, Mwelwa. And how are you doing?
I'm doing well. I'm doing well. I know this is your inaugural interview, so to break the ice, we have a tradition where we just ask you a general question where you just introduce yourself and tell the viewers who you are, what your role is at the organization.
Beautiful, thanks. So I'm Chiti Kalinda. I'm the CEO and founder of Finwise Analytica Zambia Limited. And basically, what we do is we provide cutting-edge data analytics to businesses across different sectors. We started off in 2024, and so far we've helped quite a number of institutions, be it automating their financial reporting, management reporting, and then bringing life to the data. So basically all we do is just how do we bring insights to the data?
Absolutely, absolutely. Now, recently Financial Insight had the opportunity of stumbling upon a report. It was shared with us, through some of our friends in the banks. The report itself is your inaugural report, which analyzes the performance of banks. But just to get started, what really motivated Finwise Analytica to produce the inaugural report, and how does this report align with your company's overall mission, which you just shared with us?
Beautiful. So at the core of what we do is we want to provide businesses, we want to empower them with data-driven insights. Now, these are not just any insights. These insights should be able to drive strategic decision-making, right? So the key thing that motivated us to do this is when we looked at the financial space, we noticed that every quarter when the banks publish the financials, would normally get a snapshot of profit after tax, which bank is topping, without going in depth to give more insights into why they're actually topping. So we then decided to bring this report, 27-page report, and just show stakeholders out there that the reason why this bank is topping is because of all these other performance metrics. And also the reason that this bank, for example, is lagging is maybe just because of volume, but perhaps the efficiency ratios are intact. So it's because of that lack of in-depth analysis that we decided to do this report. And you'll be amazed that this report actually is like 10% of what we do. So we do more in-depth analysis than what you're seeing in that report.
This is quite exciting because when we looked at the report, obviously it shows a lot of you've exposed quite a lot of data through the analysis itself. What would you say is one of the key features that allow this report to stand out, especially to other industry reports, and what are some of the unique insights and perspectives that it will be offering key stakeholders who get a hold of this report?
Thanks, Mwelwa. So what you notice in the report is that the way we structured the report is that it starts with the industry overview. It then moves to the comparative analysis. So you're comparing peer-to-peer banks. And then you then move over to individual banks. So normally what we would get from other industry reports would be just a restatement of the balance sheet, restatement of the income statement, and those will be in isolation.
And they get produced, I think, sometimes in the newspapers.
Yeah, exactly.
Yes.
So you'll be looking at things in isolation without looking at it from the broader picture. So what this report then does is you look at all the information in one go. You look at it from an industry perspective. Are we doing better than the industry average? Are we doing better than our competitors? Because when you're doing, for example, your strategic plan, you may have a strategic ambition to be in the top 3 in the next 3 years.
Correct.
But when you look at what the competition is offering, you then realize, is our ambition really realistic? And it'll give you clues into what you need to do to actually achieve that. But what we usually find across the industry would be reports that are not holistic, reports that are just restating what's there. And we're so deliberate that we stayed away from the commentary. And there are reasons for that. So if you look at our report, it has no commentary.
Right.
It just brings life to the data. And some of the reasons why we don't have commentary in there is sometimes commentary comes with bias.
Correct.
And subjectivity.
Correct.
And some of the industry reports will just be telling you what you've seen. So if I give you a graph that says the industry grew by 10%, I then go and write a statement and say the industry grew by 10%. I'm just repeating what you're seeing.
Correct, yeah.
So we're trying to avoid that. And because, like I said, it's just like 10% of what we do. If I have to give you a commentary, I have to say the industry grew by 11% because of A, B, C, D. And when we go in the deep analysis, we'll then now find out the deposit mix and all those complexities. But unfortunately, the information that is publicly available does not have that level of detail. But we tried as much as possible to bring in the combinations, because the balance sheet and the income statement are not in isolation. So you mix them, your return on assets, your return on equity. How is it speaking? How are we efficient as a bank? We may have the big balance sheet, but we are not efficient. And you may be surprised that some of the banks in there would have very good efficiency ratios. They've got good return on assets, good return on equity. They've got a good cost to income ratio. For every 1 kwacha they make in revenue, they're just spending maybe 14 𝗿. Other banks, for that same 1 kwacha, they are spending 16 𝗿. But because they have volume, you will find that they are top in profitability. So if you are that bank and you know that you're doing well on some of these metrics, you know that your problem is volume. So when you are now looking at your strategy, you now be saying, how do we ensure we grow volume? But at the same time, we make sure that we either maintain our efficiency or we improve on our efficiency, and then we will go through the rankings.
Right. Now, you've obviously mentioned that the report aims to empower decision makers with data-driven insights. Can you elaborate on how the report's findings and recommendations can be applied in practical terms? And I know it doesn't really have recommendation, but in terms of key findings, how it, in practical terms, can drive growth, innovation, and resilience in the banking sector?
Beautiful. So one of the things that you notice, Mwelwa, is in the report, when you look at it closely, you have leagues within the banking sector. So you've got quote-unquote Champions League. Let's hope. So you're going to have your Zanaco, your Stanbic, and your Absa. One thing that this report will tell you, and this report is a PDF report, so it's static for the year 2024.
Right.
But the model that we are using to make this report has got 7-year data.
Oh.
So at the click of the button, you'll be able to see all that info, all that report reproduced for 2023, report reproduced for 2022. And one thing that you notice is that for the 7 years, 2018 to 2024. The bank that was topping, the bank that was leading in deposits is always the bank that leads on profit after tax. Except for 1 year, 2021, when Stanbic was top in deposits and then Zanaco was top in profit after tax. But for the rest of the 6 years, the bank that tops deposit tops profit after tax. And I'm sure banks know how deposits are important.
Correct.
But again, it then goes to what mix of these deposits. Is it demand deposits that are cheap? Is it term deposits that are expensive? Is it savings deposits? And interestingly, you find that the banks that top deposits and also top profitability are the banks that rank first in the demand deposits.
I see.
Category. See? So if you're in management, for example, and your strategic ambition is we want to be in the top 3, which is the Champions League.
Correct.
And knowing that deposits, there's a correlation between deposits and profitability, you then ask yourself and say, for us to be in this top 3, we have to work on our deposits. So you then now go and the report shows you that the top 3 banks, Absa in terms of deposit has wallet share of 15%. Zanaco has 17%. Stanbic has 18%. So you've got 18, 17, 15%. Out of the entire pie, they have that. The next bank, the 4th bank, has 8%. So you jump from 15, then you go to 8%. The next bank after that also has 8, between 8 to 8, 7, somewhere there. So that's another league. Then you also have probably like the 3rd tier there. So if your ambition is to be top 3 in 2027, for argument's sake, and you only have 8% wallet share, it means for you to get into that league, it's either one of those has to kind of fall off.
Yes.
But from a nominal figure, it means your wallet share has to be around that figure. And remember, these banks will also be growing.
Right.
So what that will tell you then is, are we being unrealistic? Or how do we achieve this? So do we make acquisitions? And that's what we saw in the case of Access. So in our model, if you choose, for example, 2023, you'll see Access Bank ranked totally different ranking. But if you pick 2024 and you see that the growth rates in 2024 for Access Bank are above all the other banks, 400%, 100%, 200%, across various metrics, that's just mainly because of the acquisition. So it will then inform your how you go about your strategy. Do we acquire? Do we grow organically? If we have to grow organically, where do we target? So you find that when you look at the report, it gives you a holistic picture, how efficient you are compared to the peers, and also how your balance sheet is, size, and how that is fitting into the P&L compared to the peers as well.
Very interesting. Very interesting. Now, Finwise is invested in building solutions that transform raw data into actionable insights. Can you walk us through the process of how you gather and analyze the data for this report? You've just shared with us that you've had 7 years worth of data, and this is just a part of it. But just for us to get an idea of how you guys go about this and what technologies and methods are you guys currently using to create these interactive, graphics and dashboards?
Great. So the first thing that we do, and I'll just give you a high-level process. So what we do is we first collect the data, and I think that's the most difficult part because this data is coming from newspaper clippings. So you have to watch out and see which bank has published when, in which newspaper. And then from there, you kind of put the data in a format that can be ingested in a data model. But we're a very efficient firm.
Mm-hmm.
So we use a lot of artificial intelligence.
Right.
in terms of the data collection as well. Then from there, we'll process the data. We've got some technologies that we use which have got AI embedded in them. And this processing of the data is mainly bringing it in a format that can be easily interpreted into things like, or outputted into things like graphs. So we collect the data, we then have a process that automatically loads this data. So we don't want to be promoting solutions that talk about efficiency. We're not doing it. So our process is very automated, except for the part of collecting the data. So we collect this data, we process it, the ingestion of the data is automated. So if, for example, Bank of Zambia had a website, on their website had financials, this report would be ready 2 minutes after those financials are put on the website. So the only time that we spend is on the data collection.
Okay.
Then we also do the design. We've got experts who look at the aesthetics, how will this look? And then we go and crunch the numbers, the measures, the ratios, and then we also have a review process at the end of that. We mainly use Power BI, but we also, in other works, we use other platforms like Tableau, QlikView, but mainly like for this report would use Power BI and SQL, Python. Yeah, but mainly AI is really in.
Okay, that's wonderful. That's wonderful. Now, looking ahead, obviously this was your inaugural report, but looking ahead for future editions of the report, what emerging trends and themes do you anticipate will shape the banking sector, and how will Finwise reporting and analysis evolve to address some of these changes?
Okay, beautiful. So some of the changes that we're already seeing is this interaction between telcos, your Zamtel, MTN, Airtel, and the banking space. So right now on my phone, I can move money from my telco wallet to a bank and vice versa.
Correct.
And what that is doing is it's changing the landscape of the way we know traditional banking. What that then means is, should a bank invest in 120 branches when there are telcos that are serving some of those areas? So in the subsequent reports, we also want to highlight that kind of interaction. Who's moving money? Is it the telcos moving more money to banks, or is it banks moving money to the telcos? What's the impact in terms of profitability for the banks and things like that? Then we also see trends in terms of AI and digitalization. But the sense that we get is sometimes we'll talk about digitalization, but we don't really see the impact on the bottom line. So would want to see some metrics in the subsequent reports that will, for example, look at, has this bank reduced on the branch network? So we'll follow the trend. This bank reduced branch network. Did this translate into higher profitability or higher deposits? Kind of more like some correlation analysis. So in the subsequent reports, you see things like that. Then we'll also want to add a bit more of non-quantitative information. So you have more of the qualitatives. How many ATMs does each bank have? How many branches? How long has it been in the country? Is it foreign-owned bank? So we'll introduce some of those metrics, and we'll also just introduce some metrics that we don't usually see. For example, in this report, we had metrics that talk about the revenue per day. So a bank would know that today, every day, on average, we make 20 million kwacha. So if you have a CEO and you're sitting, and if you have a daily dashboard, for example, the 20 million is not a cast in stone number, but it will tell you how much you should move away from that number. So if you make 20 million revenue per day, and on one day you make 1 million, you should be worried. If you make 20 million a day and on one day you make 100 million, you should also be worried. You should ask, why have we made 100 million? But if you make 20 million and you make 23, you're okay.
Exactly.
If you make 20 million, you make 17, you're within the standard deviation, or like normal standard deviation. So we'll bring into light some of these metrics that we normally overlook, but are really important in driving the business, and it will actually help you shape behavior. It will actually help you shape your goals and gain more competitive advantage.
Absolutely, absolutely. No, I know that was the full-on list, but I just got word from my team. They wanted me to throw in 2 extra questions, which are more specific. Are you able to just share with us, what you observed, maybe say, for example, with Access Bank, which has been seen as quite as, positive disruptor by Financial Insight, with over 100% growth rates in revenue, PAT, and assets. And I think you kind of touched on that regarding the acquisition bit. What could be the potential drivers of this disruption?
So mainly what you notice, if you go to years prior to 2024, or let me even start from 2024. In 2024, you don't have, in that analysis, 𝗵𝗲𝗲𝗏 is missing. But in our model, if you pick any other year, you will find 𝗵𝗲𝗲𝗏. So the growth that is appearing on Access Bank is a growth of the acquisition.
Okay.
But what would be interesting, and this is where I think, because what we've presented is the information that is available in the public, but each individual bank knows why that number is there.
Exactly.
Because they have the details supporting that.
Yep.
So what would also be interesting is Access Bank, for example, optimizing the synergies of the acquisition. And normally when you make your acquisitions, maybe in the first year, you've got all these large expenses and whatnot. But it would be interesting to see the subsequent quarters and see how these synergies will reflect in the subsequent publications. Because you note that 𝗵𝗲𝗲𝗏 has ranked in the ranges of 4 and 5 in terms of profitability. And the idea is that if you're going to acquire this bank, I'm thinking you probably want to take a step further and see maybe you get into the top 3. So it will be interesting to see what this acquisition gets into. And you also see that some of the efficiency ratios. So on one hand, you'll be showing a growth, but because the efficiency ratio doesn't mind about the growth.
Correct. Yeah.
So I'll grow the balance sheet will grow by 200%.
Correct. Yeah.
But your efficiency will tell you if this growth is actually growing optimally. So if before you acquired the bank, for example, your cost to income ratio was 40%, you acquire it's gone to 70%,
there's a problem.
Then there's a problem. So it also then kinds of don't just look at the absolute numbers, but the report also then gives you an idea of, can I go and check the efficiencies and see if we can fix the efficiencies as we grow the balance sheet.
Absolutely. And then the final one is, obviously, and I know this has been a very contentious issue with some of the bankers I speak to, but some of the banks have seen a reduction in the exposure to government securities in 2024. What strategic reasons could explain, this share reduction?
Where I'm sitting, I'll think of 2 reasons. Number one would be banks looking to maximize their margins. their net interest margins. So if your yield is dropping and you've got, for example, loans, of course, there'll be a risk element aspect to the loans, but you then want to liquidate or float some of these securities and then put them in some higher yielding investments so that you protect your margin.
Correct.
So your net interest margin, your spread is protected. And remember that your biggest chunk of your deposits is demand. So there's usually no cost attached to that, right? So on the expense side of your balance sheet, which is your liabilities, the moment you tweak your term deposits, you tweak them to a certain amount. So you can say, okay, we're normally offering 12%, let's offer 14%. The nominal impact on your bottom line won't be that significant because you've got a huge buffer called demand deposits, which is free, right? So when you now say, okay, do we put more of our assets into their yielding investments, knowing that we already have a buffer on the expense side, you actually find that you'll be maximizing on your margin because the rate at which your margin is growing is not the same rate at which your expense is. So your expense is growing at a lower rate than your yield on a higher yielding investment. Of course, keeping in mind your LDRs and all those ratios. Yes. Then the other reason I would think of would be statutory measures. So if Bank of Zambia says we are adjusting our statutory reserves upwards, say by 900 basis points, and you're caught off guard. And because of reports like this, you want to be maybe number one. So you're under pressure. So you're trading probably thin. And then and remember, if you've got a big balance sheet, that adjustment in statutory reserves might mean that you need an extra 4 billion.
Correct.
To cover that.
Correct.
Your peer who's somewhere maybe not the same size of your balance sheet will probably need to raise 4 million or 40 million. So for you to raise that 4 billion and say, Mwelwa, I need your deposits, it won't come overnight. So sometimes you find that banks will then unwind their easiest assets rather than coming to me and say, well, I could pay back your loan so that we put it in statutory reserves. They'll maybe, as the investment securities mature, they'll just plug that hole and any excess now push it towards higher yielding assets, maybe like loans.
Right.
Exactly.
Chiti, that was very, very interesting. And thank you so much for sharing the insights from this particular report. Financial Insight is obviously super excited for hosting you again for another in-depth conversation.
Thank you so much, Mwelwa. I appreciate the opportunity and look out for more things from Finwise in terms of analytics, automations, and just across the industry.
Right. Okay. And for those that want to access the report, you did mention that it was a PDF. Is it available on your website? Are you able to share the website itself?
So available on our LinkedIn page. Just search for Finwise Analytica Zambia Limited, and you'll find the report there, as well as a video illustration of what you can actually do with the actual model.
Fantastic. Exactly. Fantastic. All right. So as always, we encourage our followers to continue watching and following all the insights from Financial Insight. This has been 𝘁𝗵𝗿𝗄𝗃 speaking to the CEO of Finwise. So stay tuned for more insights on all our platforms and get to know.